Bloomberg just deferred Indian bonds from its global index. That decision, made in a boardroom most people have never heard of, can move the cost of borrowing for an entire country. The question is, who actually controls that power? And why does any of this reach your wallet? Bloomberg has decided to delay the inclusion of Indian government bonds in its global bond index. Traders who were expecting that inclusion had already positioned for it, and the delay hit like a closed door they thought was open. When an index inclusion gets deferred, the expected wave of foreign buying doesn't arrive. And in bond markets, an absent buyer is almost as powerful as an active seller. That gap tends to push yields in a direction that makes borrowing more expensive across the board. Now here's the question worth sitting with. Who gave a private index compiler this much power over a sovereign nation's cost of money? And how exactly does the mechanism work? To understand what an index is, forget finance for a moment. Think of a playlist, a curated playlist on a major streaming platform. If your song gets added to one of those algorithmically promoted playlists, the ones with tens of millions of listeners, streams pour in automatically. Not because those listeners researched your music, because they trust the playlist. Global bond indexes work exactly the same way. A compiler, a private firm, builds a list of bonds that meet certain criteria: market size, liquidity, accessibility for foreign investors, settlement rules, currency convertibility. Once a bond or a country's debt makes that list, it sits inside the playlist. And then the money flows, not because every fund manager personally decided they love that country's fiscal policy, but because their fund is contractually required to mirror the index. These are called index tracking funds, and they manage a staggering share of the world's fixed income capital. When a country's bonds enter the index, those funds must buy. When bonds exit, those funds must sell. The managers don't deliberate. The playlist updated, and the algorithm followed. That's the mechanism in its simplest form. And it means a private compiler holds a lever that can redirect billions of dollars with a single editorial decision. Let's stay with the playlist analogy because it gets sharper the deeper you go. Imagine the playlist has tiers. The most followed playlist requires your song to meet a strict set of production standards: audio quality, metadata tagging, distribution agreements. If your label hasn't sorted out the distribution agreement, you don't make the cut. It doesn't matter how good the song is. India's situation has echoes of this. Foreign investors need a smooth path in and out of a country's bond market. Clear settlement systems, no surprise taxes on the way out, the ability to move money across borders without friction. These aren't small administrative details. They are the production standards of sovereign debt. A country can have a large economy, a deep domestic bond market, and strong fundamentals, and still miss the playlist because the paperwork backstage isn't finished. Once inclusion happens, the mechanism runs in both directions. Entry triggers automatic buying from every tracker in the world that follows that index. Deferral, or worse, removal, triggers automatic selling from those same funds. Neither wave is driven by opinion. It's mechanical. It's the playlist updating. And because the sums involved are so large, even the anticipation of inclusion moves prices. Traders position ahead of the announcement. When the announcement disappoints, those positions unwind. That unwinding looks like selling pressure even before a single index tracker has acted. This is why the deferral of an index inclusion is never just an administrative footnote. The expectation was already priced into the market's posture, and now that expectation has to be repriced. Here's where this leaves the abstract world and walks into your life. When a government borrows money, which every government does constantly, it issues bonds. The interest rate on those bonds is the government's cost of funding. If foreign buyers are plentiful, competition for those bonds pushes the interest rate down. The government borrows cheaply. That cheap borrowing flows downstream. It influences the rate at which banks fund themselves. And bank funding costs flow into the loans they make: mortgages, business loans, the credit lines that keep a factory ordering raw materials or a trucking company paying for diesel. When index inclusion is deferred and the expected foreign buying doesn't arrive, the government may need to offer a higher yield to attract enough buyers. A higher yield on government bonds pulls other interest rates upward with it. That's not a chart on a terminal. That's a slightly larger monthly payment on a home loan. It's a business that finds the cost of expanding just a little steeper than it was last quarter. It's the price of imported goods edging up if the currency softens alongside the bonds. None of these effects arrive in a single dramatic moment. They accumulate quietly, in basis points, in revised lending rates, in decisions not to expand that get made in the back office of a small company. The person who never heard of a bond index still lives downstream from its decisions. That's the part the financial press often skips. So let's return to the question from the beginning. Who gave a private index compiler this much power, and why does it reach your wallet? The answer is that nobody gave it to them deliberately. It accumulated. As passive investing grew, as more and more capital shifted from active stock pickers and bond analysts into low-cost index tracking funds, the index compilers became the de facto gatekeepers of global capital flows. They didn't lobby for the role. The market handed it to them, one fund conversion at a time. What Bloomberg's deferral of Indian bonds illustrates is a structural feature of modern capital markets, not an isolated event. Any country seeking deep integration with global capital has to satisfy criteria set by private firms that answer to their own methodologies, not to any electorate. Meeting those criteria takes time: settlement infrastructure, tax clarity, regulatory alignment. And until the criteria are met, the playlist stays closed. When it opens, the inflow can be large and fast. When it stays closed, the absence is just as consequential. This is a mechanism that will keep repeating, with different countries, different indexes, different timelines, because the underlying logic doesn't change. Passive capital needs a list to follow. The list needs a compiler. And the compiler, whether they sought it or not, holds real power over real economies. The next time you hear that a country's bonds are being considered for index inclusion, you now know that's not a technical footnote buried in a financial newsletter. It's a decision about who gets cheap money and who pays more for it. And that, ultimately, is a decision about everything else. If this mechanism was new to you, the channel has more explainers on how the infrastructure of global capital, indexes, ratings, reserve currencies, quietly shapes the choices governments and ordinary people can make. Subscribe so the next one reaches you automatically.